So welcome. Thrilled to have everybody here. Thrilled with the turnout. We're going to get right to it, as they would say, and we're going to just start off. If you look at the day, we go through. I try to set the stage and kind of review what the state of the world is in a lot of different areas. We've got Shalimar Alexander coming down from Purdue to talk about soil health, and Rodney and Stephen to talk about soil health and technology. After lunch, Jack Albrecht will be here. He's a futurist. He calls himself the non-economist. And I heard him speak in January, and I thought he had some very interesting insights that as we try to manage and strategically position our businesses for the next 10 years, that we might want to keep in mind. So Jack graciously agreed to come and speak to a bunch of farmers in Indiana. He usually speaks in New York City at the Plaza, so it'll be a unique experience for him as well. And then this afternoon we'll wrap it up with a presentation, which I haven't finished yet, about what we're going to do about it. So the big picture, last year I had this picture of the perfect storm and that movie that was popular probably 10 years ago. Does anyone know the name of that boat? The actual ship that sank, that the story is about? Probably. What's that? The Minnow. That's a good answer, Chad, but that's a wrong answer. I'm so glad you're here, though. We'll come back to you later. No, the Andrea Gale. So, and the things that we all talked about last year, right, about how kind of overblown a lot of things are, what's happened in the last 12 months? They're just more overblown. We talked last year about whether Trump could win or not, and of course Trump did win, and how did he win? He got the white rural vote. I would argue not the white farm vote, because there's not much white farm vote left in America, but he got the white rural vote. So the big picture, the kind of summary statement is it's deja vu all over again from Mr. Yogi Berra. It's amazing with the internet how easy it is to get stuff like that. It took me 12 seconds to find the quote and even get a picture of him with his Yankees uniform on. So I love the technology, what it lets us do. Rod and Stephen will both be talking a lot about technology and how we bring it back to the farm. So when we jump right into the big picture, things have blown up, of course, and one of the things that's really interesting to me, and I really think this will be the unwinding of things in the future, I saw a study that said 80% of investment decisions now are made on some sort of a momentum investing strategy, which is really a phenomenal number. And this cartoon, I think, is just really perfect. And I think it's what we see in the markets. If you just look at how fast the quantity of trading and the volume of trading and the flow of funds around the world, it kind of is exactly like this. And it's hard to tell when you turn on the screen in the morning what the prices are going to be, because you don't know what they've decided the prices are going to be. So, but never before in history have we had so much of the money flow in the world following what everyone has agreed is the right way to make investments. And that's basically momentum investing. And of course, momentum investing always have to have extremely vicious volatility just because of the way it works. So that's interesting. I presented this data last year and had a few people say that global warming told me it wasn't real. And so I've changed the viewpoint on that. All I would like to point out is that mankind is having an impact on carbon dioxide and nitrous oxide in the atmosphere. If that doesn't cause global warming, that's fine. But to say that man's not impacting the Earth's atmosphere is not really true anymore. The other thing, that probably the biggest thing in the world, and we all understand this in agriculture, right? That, my gosh, commodities are cheap. Versus the S&P 500, commodities are extremely cheap. Land is not extremely cheap, but commodities are extremely cheap. And that commodity number includes all kinds of things: cattle, hogs, corn, beans, gold, silver, oil. And the thing that's interesting about this is at some point the valuations become so extreme that they just have to correct. And interestingly, if you go back and look through all this, there's always been some sort of a crisis that causes the end of that trend. And, you know, we've talked last year, and we'll talk this afternoon about how long and extremely depressing, I guess you would say, the declines have been, and especially the grains. But it's a good thing to keep in mind just how out of balance and this, again, this is a result. This is an intentional result. I mean, the Federal Reserve doesn't want to say this, but this is an intentional result of 0% interest rates. I would make the argument that we are, you know, you hear, if you listen to Farm Bureau testify in Congress, we have to invest in R&D for agriculture to feed the world. I would argue that we're over-investing about $20 billion a year in R&D and ag right now. We don't need the product. And why are we making the investments? Well, we've got intelligent property laws that let 3 companies decide how much we invest. And those companies, with 0% interest rates, or almost zero, are making incredible long-term investments. And we're all doing the same thing, right? We got farmers in northern Kansas putting in drip irrigation systems with a 7 to 10 year payback, which is probably hard to justify, but okay, if they've got the money, let's do it. But you know, if interest rates are 7%, that's an 18-year payback. There's no way that goes in, and there's no way that supply of corn is created, because what's drip irrigation get you in northern Kansas? Probably 230 bushel corn on 120 bushel corn ground. So we're going to do that to grow some more $3 corn. So I was at the Indiana farm, they had a farm policy meeting, the corn growers and the soybean growers in Indianapolis, and I heard 2 points that were very interesting to me. One, you know, farmers always leave land better than they found it. We're the original environmentalists. And my question would be, then why is it all in the Gulf of Mexico? You know, if you look at, you know, percent of, even Indiana, percent of fall tillage is still around 36%. And this is in a state that gets 8 to 13 inches of rain in January, February, and March, where the ground is bare. And I'm not saying you have to do things the way we're doing them with trying to keep stuff growing year-round, but I'm saying if you're going to make the case that we're not hurting the environment, you've not looked at the rivers this summer in the Eastern Corn Belt. We've had chocolate milk rivers every month of the year in Indiana. And just in case you think nobody else figures this out, our son-in-law is from Cleveland, Ohio. His uncle is an attorney in Cleveland. And we met at one of the family get-togethers, and he said, you know, just so you guys understand, we all know the algae in Lake Erie is your fault, because the algae in Lake Erie is our fault. So a lot of people understand what's going on, and he says, we're not going to politically make a big deal out of it. We can't stop you from doing it, but just so you guys know, we know that it's your fault. But anyway, kind of back to this point, commodities are really cheap, which is really interesting. It's kind of an unintentional outcome. And globally, we've done this right. Everyone's done the same thing. Interest rates are cheap everywhere, which means what? It means Russia's planting too many acres of wheat. It means Cargill has got $100 million invested in Russia, so they're not going to stop planting wheat. So you actually create an environment where you have artificially low interest rates that causes an oversupply of everything, which depresses economic activity, but does let us put a lot of money into the stock market. Total credit market debt, you know, I didn't have a chance to verify if this slide is accurate, but it does capture the fact that we just continue to print money through debt all around the world. One of the other unintended consequences of, I think, most of technology, but also the monetary policy that we have on a global basis, is the fact that the share of U.S. household wealth, and whether you like it or not, the policies of the last 20 years and the technology that allows us to scale up businesses like Google to government-sized entities, the wealth is coming extremely concentrated. This is the top 0.1%. This is not the top 1%. This is the top 0.1% of the citizens of the United States control 20. If you extend it out to this year, this is in 2011 data, we're pushing 25%, which is about as far as we got in the Great Depression, I mean before the boom. But if you think the United States is bad on this, you'd be wrong. Venezuela, for example, a socialist nirvana. At least it was going to be. The top 0.1% of the people in Venezuela control between 60 and 75% of the nation's wealth. It's the way it works in socialist communist countries. The people in charge have all the wealth. Nobody else does. So our system, despite the fact that this trend is concerning, usually the way that stuff ends is the poor people decide enough is enough is enough. That's the way that normally happens. And I kind of like to make the jump that, we go back to this whole deja vu kind of concept that the things are just the same as last year, only even more extreme. But that's okay because we've got the Andrea Gale. The name of the boat in the movie is the Andrea Gale. The Andrea Gale has a new captain. And, whether or not you're a Trump supporter, you're not a Trump supporter, the people tried to make a statement to Washington through him that, most people know that unlimited debts don't work. So the only candidate that we could choose that we could make a statement to the bureaucracy is a guy who truly loves debt, right? He's been broke 3 times. He borrows billions and billions of dollars and has seen it work out pretty well. He ended up as president. So the concept that we're going to manage the debt under a Trump presidency doesn't make any sense in terms of his personality. I'm a big Mike Pence fan, so I voted for Pence because to me the Democratic choice for vice president was so bad that it was just real simple. But he does love exports. And he's being educated to the fact that who actually elected him are the middle class, white working class people in the South and the Midwest of the United States. He gets that. His pick for vice president was genius. Mike Pence has spent an entire career developing a huge network of support in western Pennsylvania and southern Michigan and Wisconsin and Indiana and Ohio. And if you look at who won the presidency, it's 4 or 5 counties in those states picked the president of the United States. So it's very interesting, but the thing that's interesting, this guy is also almost like the poster child for what Obama did. This is if you take the CBO budget scores, this isn't some Trump basher that put this together, that's the Trump tax plan. And of course he won't be in office all the way out here, and of course his plan wouldn't be implemented anyway in its entirety. But it kind of reinforces the point that doing the major tax breaks, the way they're looking at doing them, will build the deficits back. And of course the spending cut proposals, when you compare all of the stuff that's locked in like Social Security, it's not going to bring the spending back down. So if we thought that the $1 trillion deficits were going away, they're going back. And by the way, the CBO scoring assumes 2.5% economic growth every year for the next decade. So just imagine if we don't have economic growth. So I like to say it's deja vu all over again, but we've got a new captain on the ship, and we'll see how he does. One thing that's interesting to me, how do people think Trump is doing so far? I love going out in July and August. We settle up with our landlords, and I love those conversations. They're all great people. We settle up for inputs, and then review last year's financial performance and go through all that stuff on their farm. And it's interesting to me kind of what your background is really, truly determines what you think of Mr. Trump at this point. It's just amazing to me. And a lot of people are more offended by his style than his policy. Almost everyone thinks his policies are pretty good. I mean, we're actually shipping beef to China. That's a really good thing, right? We're shipping rice to China. That all happened in the first 90 days of his presidency. So he's doing a lot of really good things, but the style offends some people. So it'll be interesting to see how that works out. But I do think that it's important when you look at the big picture that, why couldn't the Republicans repeal Obamacare? Ultimately, why? Because a few million people are going to lose their free coverage. So we just allowed a few million people to determine the course of a 350 million population nation. And that's not going to change. And so if that's not going to change, the whole concept of debt and and managing it to a more manageable level is just not going to happen. And then ultimately, the outcome of that becomes somewhat predictable. So ag exports, and we touched on this last year. We export 35% of all the ag products in America, give or take a few percent. And where do we send them to? Well, we send them to, thank goodness, we send them to our friends in Canada and Mexico, China, EU, and Japan. And a couple of things that are fascinating to me when you look at that chart, it's actually been awfully consistent, right? I mean, other than the emergence of China since 2000, everybody else has been pretty much on the straight and narrow in terms of where stuff goes. So let's take a look. I like to talk about the debt and how it becomes completely ludicrous. Let's take a look at those at least 4 of those 5 countries and see where they stack up. So we're really blessed in a way. Canada and Mexico have really some of the lowest debt levels in the world, and Mexico has an extremely low debt level because you just can't afford to lend them any money because they won't pay it back. But what does that mean for Mexico? If the global debt thing does kind of melt down and we have a debt crisis, it means Mexico's fine. It doesn't change the standard of living in Mexico at all. It probably actually increases it. So 2 of our big export destinations are relatively stable financially. The second thing that becomes kind of interesting about that is which are the 2 countries that we're trying to pick on a little bit. So I don't know why we would want to do that. The other 2 countries, though, are 2 countries that are really extremely leveraged up, let's put it that way. Extremely leveraged up. But the differences between Japan and China are kind of striking. But they both are extremely leveraged up, and they've done a lot of crazy stuff. But let's just focus on China. Why do we care about China? 60% of the beans go to China. If China would not buy soybeans for one month, it basically really messes up the price for soybeans. So China's obviously extremely important. And this is just looking at soybeans, but if you look at every other commodity in the world, it's the same number. If you look at copper, if you look at oil now, China's where it all goes. So we should be concerned about China. And what do we know about China? Well, there are a couple of things about China that are very different than the rest of the world. If you go to Japan, all of this, and of course this is debt to GDP, and arguably you should never increase your debt to GDP if you're managing your business at all. But in 25 years, Japan has obviously doubled it and got nothing to show for it other than more debt. But the government owns a lot of this debt in China, in Japan, I mean. If you look at France, there's a lot more private debt. But if you look at China, look how upside down that is. Most of the debt in China is all from corporations and private individuals, which of course means what? It means that it's a lot harder. You can't just print more money to cover up these debts. Japan just keeps printing more money, and because their import-export balance is almost equal, they can get away with just loaning themselves more fake money. But China's a lot different because it's mostly individuals and corporations and shadow banking systems. And so then let's look into China. What's going on in China? So we have this huge debt. China's gone, if you look at this, from 1980 basically to having extremely low levels of debt to, this is 2015. By 2017, they're probably the most indebted country in the world excepting Japan. So what's going on in China? Well, they decided to reflate after 2008 and do all of this because everyone else did it. And a typical new home in Beijing right now costs $870,000, 2-bedroom, which doesn't sound that expensive, right? I mean, in New York it's more than that, but it's 69 times the average wage in Beijing versus New York City at 25. So you have property that's really kind of gone crazy in price. And if you look at their lending statistics, a lot of this debt in China is being lent to people for real estate. And this is a long, you can read this on the site, but it's a long worded thing, but it's just interesting to me. Home prices in Beijing rose 63% in 18 months, which of course is a sign of a nice, stable, quiet market. But look at what people are doing. The government's changed the rules so that they've got this real estate agent that just marries people so that they can buy a second and a third house, and then divorces them and does it all over again. You've got a citizen from Shenzhen saying down here that he and his wife got divorced in February so they could buy a fourth apartment in Shanghai for $530,000 so that they don't miss the chance to get rich. Unremarkable pieces of land in Shanghai are selling for $2,000 a square foot, $87 million an acre. I would argue you're better off to go 18 miles west and build the building there where the land is $4,000 an acre, okay? But I understand it wouldn't be in Shanghai. So you have this incredible speculative fever going on in a country that has no financial regulations really at all. And even the ones that they do have, the government controls the printout on. So it's fascinating how leveraged up China has become. Yesterday we talked a little bit about kind of making the, so I'm trying to make the connection here between our biggest export customer is really an interesting financial position. And yes, if China has a business cycle downturn, the government's going to print trillions and trillions of yuan because they can. But all of the people that import stuff into China are still kind of private companies that get licenses. So there is a chance for a hiccup, especially with this kind of speculative fervor going on. The housing market boom in China is about twice the size of the subprime mortgage event in the United States, which we know pretty much took down our banking system. Of course, when you have someone that increases purchases of soybeans by hundreds of percent in 10 years, you have things like this. So the connection here is really simple, that we're not much different than the people in China, right? And I got this data. I went to the University of Missouri, has what I thought the best data was, and whenever you see a land price chart, usually with extension publications, they always do what? They always adjust the price of land for inflation. And all of us know, especially if you were around in the mid-'80s, you can't pay off the farm with inflation, right? That doesn't make the mortgage payment. But I think I just went back to the Missouri data and just put it on a regular bar chart. Just typed it in because it was so hard to get a chart that made a lot of sense to me. Most charts actually start like in 1990. Well, that's a real good time to start the chart. That's like starting the stock market chart in 1937. And the other thing that's interesting about this, if you look at this chart and you're a young man, I was talking to Brian Burnell last night. He was 2 in 1986, but none of us were around for this, right? Does this look like the Great Depression to you? Of course not. It doesn't even look like a blip on the chart. So I'm just pointing out that, and I put a 5-year average on here, and it's interesting to me. So if you let's go back and look at this period of time back here and see what happened. And yeah, land prices went straight up in the 1910s and the 1920 due to the First World War. But we had this real interesting, land started down a long time before the stock market peaked out, almost 5 years. And so as you got to this, if you think about this, and I've just pointed out here that the 5-year average, when the land price went below the 5-year moving average, land had to, in essence, reset. And of course, it had reset in 1929 by 40% before the stock market crashed. And then the rest of this is the debt devaluation. So it's real interesting if you think about this. This is all just agriculture over here, and then this is all just money flow over here. But when land went below the 5-year average, it had to reset. If we go back and look at the 1980 event, if you would have sold land when the current price of land went below the 5-year average in 1983, you would have been a lot better off to buy it back in 1988 when the price went above the 5-year moving average. So there's nothing wrong with these old school indicators called moving averages. They still work. Since that time, of course, in my entire business career, my father started farming in 1970, so he's been through this. But since that time, of course, goodness sakes, it's just been straight up. And I like to point out that this past year, 2016, the price of Iowa farmland is exactly on the 5-year moving average. And so what's 2017's number going to look at? going to look like? You know, you got a land expert in the room. Bill, what's land done this year? Is it going up or down? Yes, exactly, right? It's basically gone sideways. So we're right at the 5-year moving average, which keeps increasing. So very, very possible that land would dip below the 5-year average this year or next year in Iowa. And always in the past when that's happened, we've had a 3 to 6 year consolidation period. So it would seem to me like if you go back and look at this chart, it's probably not a very good time to buy farmland. Of course, I said that last year, and it's basically unchanged from last year. But I just think we really want to think about that. If you do the inflation adjusted on this chart, it comes out to about $4,000. And just a normal, this is like every one of these land resets we've had has been 50%. Normal retracement gets Iowa Land Act about $4,000 or $5,000 an acre. That is not a catastrophe by any standard. But it does make the guys from Iowa that paid $14,000 an acre feel pretty bad about it if it becomes worth $5,000. And of course, what do we know about real estate, right? It's very regionally specific. We're close enough to Indianapolis that even in 1980, the land didn't go down here like it did in western Iowa. So if there are other uses for the land, and of course we keep burying land under concrete through most of the Midwest. But the point I'm just trying to make is that it's a good time to think about holding the reins on that. And then, of course, if you look at land to income multiplier, again, another probably unintended result of 0% interest rates causes stuff like this to happen. But, you know, at 34 times earnings, very few people would want to buy stocks back in the old days. And, you know, that's really what you're paying is, right now. Land's worth about 34 times earnings. And that's with cash rents that are actually showing losses to the operators. So if you look at it from an operator's perspective, land might be closer to 40 times earnings. Again, I think this is something to give us pause. And that's what the whole point of the big picture presentation is to think about where we're at in some of these long-term valuation cycles. And, you know, if we want to jump to interest rates, you know, they keep going lower. And in fact, they went negative in a number of spots in the world last year. But again, they are, you know, in the United States, interest rates are down just about where they were in 1941. So can they go lower? Sure. Will they? Boy, at some point they won't. The Treasury bond market, same thing, you know, extremely high because of low interest rates. We do have a kind of a nice rhythm that's developed in terms of the trading action in the Treasury bonds and with these 6-quarter swings. And we have a high here in the fourth quarter. And one of the things that's interesting about that to me is if and when the stock market ever rolls over, where's all that momentum money going to go? Initially, it's going to go to the bond market. So pretty easy to see have a spike back up here in the fourth quarter of, that should be 17, not 16. So if you think about the big picture, rates may even stay lower. They may even get lower in the next 3 or 4 months. And I think that's also an opportunity for us because we'll talk a little bit about managing adversity this afternoon. And, you know, we talked yesterday, the guys that were here, you know, the first step back for the left tackle in football, the first step on the hike in a pass play is back. So stepping back, backing away, refinancing now while you can, and especially if we have a spike lower in interest rates on fear in the stock market, it's going to be a good opportunity for people to get repositioned. We still get calls from Prudential Ag. They want to loan money on farmland. So if you're not liquid enough, we're probably going to have a chance to do it this fall. I threw this chart in here again because it's such a dichotomy, right? I mean, goodness sakes, this is the land chart, and this is the valuation charts. And so obviously that's driven by the stock market being extremely really high, but it's also real interesting that, you know, you can keep land that high and have commodity prices fall apart like they have for such a long period of time. And so when I do our numbers, I'm assuming our numbers are similar to your numbers. The working capital just keeps going down. The total debt keeps going down because we're paying off long-term debt, which is why the working capital is going down. We're basically running break even the last 3 or 4 years, making a little bit. But we're getting into a position where it's definitely time to think about doing things to keep driving the cost down. And one of the things you do to drive costs down is you pay less and less for farms. And yeah, that may not be the case today, but we're getting to that point where all the bankers are going to have to start rationalizing some tough decisions. Obviously, we know the stock market, staying on the big picture theme, the stock market's gone. Two things about this chart that are real surprising to me. Can you tell when the election was on that chart? I thought Trump was it was an earth-changing event, and it's really hard to tell. I mean, it's obviously in this quarter, but if you look at this chart, we've been through 3 presidents, and 2 Federal Reserve chairmen. The point just being, it's this cheap money and incredibly abundant cash has allowed this thing to happen. And so what have we done here in the last year? We've got people like the Swiss National Bank buying up huge shares of Google. The number I saw was the Swiss National Bank owns $1 billion worth of Google stock. And again, remember, governments always buy the top and sell the bottom. And it's just kind of fascinating that we even have the smart governments like the Swiss buying U.S. stocks. How do they rationalize that? I mean, in terms of being a central bank, there's no way they should be buying stocks. The Japanese central bank owns about half of the stocks in Japan. It makes absolutely no sense. But the way they rationalize it is they're momentum investors. The federal banking systems have all become momentum investors like the other 80% of the world. And I don't know what the trigger will be that will cause this thing to roll over, but the one thing we do know is there's absolutely no parachute underneath the thing. A couple of warning signs in the S&P, and the reason I bring up the S&P as being so important in this is the data is so good, the market is so heavily participated in internationally, globally. But we have for the first time in 5 or 6 years, we have the Hindenburg omen. Don't you love the word, the Hindenburg omen? But yeah, that we have, and the Hindenburg omen is just that you have more stocks making new lows and making new highs. So we have a market that's very, very old in the tooth and also extremely overvalued, and is starting to give us signs that we should be worried about it. We'll jump around a little bit at that point, but when we get into the S&P and we look at how the money flow has occurred, remember that the NASDAQ is the speculative vehicle. The NASDAQ's far more vertical than the Russell or the S&P. The S&P has stocks in it like oil companies, and not Cargill, but the publicly traded food companies, where the low food prices haven't helped them make money. I saw an article a couple of days ago about how tough it was for ADM and Cargill to make money because the value of commodities were so low. And I thought, boy, tell that to a wheat grower in Kansas who's getting $1.20 under for his wheat. It's probably depends on whose foot the shoe is on that. But so let's just jump across some of the other markets. We want to set the stage for the big pictures of things, and you're going to find a lot of the charts today. We'll be talking a lot about 18 and 20 as being important, and I think it's very interesting in the crude oil market that we've had arguably some international troubles that should have concerned the oil market, and it doesn't. We brought Jack in to talk this afternoon about how fast technology is changing the demand for liquid fuels, and how fast and the incredible amount of money that's being spent to make that happen very quickly by people like Google that have tens of billions of dollars to make it happen because interest rates are so low. The 114-month cycle on here, for you guys that haven't been here before, that's discounted from the last low over here back in 2000, 114 months up. That cycle ends in December of 2017. So look at the momentum in this chart, position of the commercials in this chart, open interest. It seems very likely that crude oil just kind of slides back to test the lows, just like wheat did, just like corn's in the process of doing. And it's just part of the hangover of this huge commodity inflation that we have in 2008 and 2011. somebody asked yesterday, just a definitional, and we'll talk about it again. Red triangles are lows, either past ones or ones that you would anticipate. Purple triangles are highs. Blue diamonds are just, I don't know. But the timing point will become important. So one of the things that we have a huge open interest in the crude oil business. So we have a lot of money that's flowed into crude oil. And whenever we have the next run up in prices, it should be pretty strong because we have a lot of commitment. But right now, all this money has come in on the long side, and what have the prices done? Absolutely nothing. Does that sound like any market that we're all really familiar with? Like Chicago wheat or corn? We had huge money flows into corn in July, and we got a 21-cent rally out of it. So it's very similar. And of course, if you're a follower of Flanagan and Gone Global, and you know about the 60-year cycle, the 50s were a very flat decade in commodities, and this is kind of the way that the 10s are shaped, or from 2014 on is shaping up very flat. So crude oil is not overvalued, it's not undervalued. The dip back here in April and May, we just filled the tanks and contracted the stuff. We got some really good prices on LP for this fall, we thought. But we don't see, from a timing perspective, any reason for this thing to explode. Someone said yesterday, well, what if something happens in the Middle East? And the interesting thing behind that is it's not 1980 anymore. We really could live without Egypt's oil because we don't need it anymore, especially in America. We're pretty much fuel self-sufficient. So it's really not so much something happening maybe in the Middle East. What if something happens to us? What if we have a big accident somewhere? What if we have some fracking earthquakes that really blow things up and change our trajectory? But again, it just should back and fill. That doesn't mean it can't race up here. But when we look at some of the other markets, you kind of would sit back and say, how can crude only be $46 a barrel with what else is going on? The gold market, got a little bit more timing stuff on this one. Gold is, if you come back and look at most of the other commodities that we're going to look at, gold's still extremely overvalued versus commodities, especially silver. But of course, it doesn't mean that we can't continue to rally higher here into the first quarter of 18 or even the second quarter of 19. But we have almost all of these major waves kind of come out in the 2020 to 2022 range. And if you think about this, if the stock market would roll over going into the first quarter, we've got a lot of really great timing harmonics for a high-end gold in the first quarter. We had the guys come in and talk last year about demographic trends and all those things, and he was expecting $800 gold this year, so he was wrong. But I would argue it was just too fast. It just needed to take some time. And another, if interest rates are zero and nobody cares, a certain portion of all that currency is going to go into gold as a safe haven. But again, if you look at all the other commodities, gold is extremely overvalued versus what they are. So where are you going to put the money? You can't. If you're a big investment fund and you know this, and you know that commodities are undervalued versus stocks, where are you going to put that 10% of your portfolio? Well, you're probably going to put it in silver. Silver is, when we have all these rallies, we've been talking for years about how the market declines to the quarter of its range, the 0.25 of its range. Silver has done that. And the timing in silver is completely different than gold, which is fascinating because you think they'd be the same. Silver actually has really constructive price performance, and again, the timing over here in 2018. So it's extremely possible to see silver have a real nice move in the next year and a half. And we have, interestingly, in the commitment of traders, the specs all got in on the first leg up and have all kind of gotten back out. So the market can kind of go where it wants. I changed the order up a little bit because we always tend to do the livestock last, which is unfair. You guys have seen the circle in cattle and being broken, and we had those dates on there back when they were trading at 150 or 160. Once something like this happens in cattle, this interim period in here becomes much, much less predictable. And that's just being honest. Yeah, we had the collapse right down to the price support levels that we thought we might get to, or even a little bit beyond. We had the recovery into June 17. That June 17 high has been on the chart for a year and a half. And then going forward, you'll notice I have a high in 18 or a low in 18. And basically, I'm just honestly pointing out that September of 18 and then February of 2021 are going to be very important in the cattle market. And today it's really hard to tell how they're going to be important. So, I mean, I would love for us to have a commodity bounce in 2018 across the board that we can all do hedging on, but I'm not sure we're going to get that opportunity. And for the people that aren't in the cattle business, just imagine if in your entire lifetime the price never went below the below 2 or 3 years ago, and now the price is way below where it was 2 or 3 years ago. So they're definitely having to get used to a different type of environment, which we talked about 2 years ago. And going forward, if you think about what normally happens in a debt reset, I went to the grocery store a few weeks ago, and you know what? Beef is still way overpriced versus chicken and pork, even though this has already happened to the price. So, and if you think about the distribution of wealth in America charts that we looked at, and you think about the people that are on food stamps because we intentionally underreport inflation, and if you look at shadow stats, they're saying that we're underreporting inflation by almost 100% in the last 5 years, 200% in the last 10 years. Well, that's a tax on the poor. And so the food stamps aren't going to buy as much beef. And 50% of the people in America are on government assistance. So if you think about the beef business, it's going to be a tough place to be. And then, of course, the feeder cattle just being a derivative of all of that. The feeder cattle have been a little bit easier to work with. But the dates are going to be the same, but how this is going to work out is just going to be very interesting. Because the one thing the cattle market has going against it, right, is this phenomenal increase in pork production from like a year ago until now. Huge expansion because we're putting the plants up. Of course, we aren't killing all that pork yet, but there's just going to be an awful lot of pork in the world, and that assumes that our export customers keep buying it forever, which I think is a risky assumption. One of the things, I've put commitment of traders on all the charts down here, and we'll talk this afternoon about how to use that a little bit more. But even last week, so in this, now this is a contract rollover right here. But even if you look at the last 4 or 5, 6 weeks, especially this past week, the hogs are down $8 a hundredweight, and the speculators still haven't sold any. This could get really ugly, and the cycles would indicate that the hog market should get really, really ugly. We've been 100% hedged since June. We're going to stay 100% hedged and pray that we're wrong. But at this point, on any kind of a financial scare in the marketplace, speculators have to sell 75,000 hog contracts, and the commercials have to buy them, and most likely the commercials aren't going to buy them at a loss. So anyway, it's just you can see how this fluctuates over time. You can see back when we had PEDV that the speculators got a little bit long, and it took them a long time to work that off. But the way these momentum funds work, if you think about this, the speculators over here were long hogs at 120 and didn't get completely out of their long position until hogs were trading at about 60. So I'm not really opposed to speculators being in the marketplace, but we do need to understand what their position is and how they've influenced it. And this entire run up in this 4 or 5 months in here is all speculative money driving the price, all momentum based. Had nothing to do really with the supply and demand of pork. Sugar. I throw a lot of these charts up here that are, I like to throw sugar in because sugar has worked the analysis from a time perspective, just for a little background, you start the count time-wise here, and you end the count at the high, and you just propagate that wave kind of across the chart. So this particular time point right here is exactly 0.618, which is the golden ratio of that length of time. And the 1/2 point in here was also important. But the only point I'm trying to make in here is that sugar is in, so compare the position of the hog market where you have speculators owning huge position in dead, they call them lean hogs, like they call them dead hogs, because at that point they're dead. And you come to sugar, and it is completely the opposite. And if I put open interest on this chart, it's at a record level. So some of these funds that have money, that want to put a certain amount of their money into commodities, because going back to that chart, commodities are extremely cheap versus the paper assets. They're taking huge positions in sugar. And on this particular, we're down in here at a point, so the commercials that use sugar own more sugar in the futures markets than they ever have in history. And the price is at support. If you look at the waves in time, it's at time support. So we can build a really strong case, as long as the low from 2 months ago isn't taken out. The sugar could have almost a ballistic move into May of 2018. And I bring that up because if you go back and look at some of the other charts, we could have a lot of the charts are set up because commodities are so cheap and the timing rhythms are set up so much that we could have a nice move higher in 2018. So I'm not going to be here being bearish corn or wheat because they're so cheap. There's no reason to be bearish corn or wheat. And we have this almost singularity in time when we have a lot of these markets that could have a real nice move higher into 2018. And what do we need, right? We just need a really small weather problem anywhere in the world to make that happen, because the supply and demand is so tight at these price levels. I always like looking sugar and coffee together because most people put sugar in their coffee. But a really very similar event in coffee. That the time patterns are all the same. This chart almost looks like the wheat chart where we've gone just down forever, just like the sugar, and going sideways forever. And these rhythms, when you come across, obviously the timing works pretty well in coffee. You look at how we can have these huge speculative builds every once in a while in coffee. And we end up now in September and December in a period when we could put maybe a low in, but then again, we have this major timing rhythm in July of 18. And Eddie and I were talking last night, or the whole table and I were talking last night about, why do you think 2020 is going to be such a low? Why are you so worried about 2020 and 2022? And a lot of the reason is because a lot of these commodity markets that are real undervalued could have a nice move higher into 2018. Just in terms of a relief rally, right? Just because they've been down for so long. And if that happens, it becomes extremely unlikely that you have a high in 2018 and another high in 2020. And especially with the what I consider to be an extremely precarious global economic position. So let's talk about, I think there are 3 bull markets in the world in commodities right now. One of them's copper. And copper has always been on a different time wave than most other markets. Everyone calls it Dr. Copper for a reason. But if you just look at this chart, it's fascinating to me. So we have a market, right, that bottomed first because it's just on a different time wave. So that's, in my view, it's a little bit like wheat. It tends to lead a lot of the other commodity markets. And it built a base right around the timing point like it should have, and then it started to recover and recovered. And there's 2 different wave patterns, made a high in February right when it was supposed to, and now we're racing higher right into what should be a high in September. And just look at this. Open interest in copper is 330,000 contracts. 3.5 times what it was in 2009. So what do we have? We have huge, remember the momentum investing theme a little bit. We have huge money flows into copper. The economic activity doesn't support a high copper price. we've had huge money flows into copper. We've had huge speculative flows into copper. Um, and, 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 and because copper should top out in September of 17, which is basically this week or next week, but it also has a failure leg in July of 18. So in the markets that have started out earlier, have gone farther to the upside, have huge ownership by commodity investors, they run out of time all at about the same time, even though their counts start at different points. So we have what I've termed as the singularity, where we have a lot of these timing counts coming together. And if you look at when copper should make a low, then it's in 2021. So I would start to say that there's a growing case that the paper asset bubble comes to an end this year for political reasons, both in America and overseas. I mean, America's got its act together more than any other country in the world, and we're kind of spiraling at the same time. So, just an incredible build and open interest on this rally. And this is the kind of build and open interest that we should expect if we can ever get the ag commodities going, which would take the spec long position in corn another billion bushels higher, for example. So let's talk about wheat. Kind of very interesting. Wheat's been on this incredible slide since all the way back in 2008. Longest, steepest bear market in history. We talked last year that we should have a recovery or a relief rally that we did. And maybe we didn't all take enough advantage of it because it didn't go as far as we thought it should. But it's building a base. Wheat's one of the few markets in the world right now that's actually still in a bull market, and this is Chicago wheat, which is one of the weaker wheats. But it's building a base, and we'll talk about Minneapolis wheat in a little bit. Corn market, right? Same thing. We continue to build a base. We didn't get nearly as high as anybody would hoped we could have in July. But when we look at the open interest, and I just don't have it on this chart, with the commitment of traders in corn, the rally in corn and wheat, the problem wasn't that we didn't get the speculators in, we did. The problem was the commercials sold too much corn to the speculators at too low of a price because we have too much corn in the world, right? So, but from a timing perspective, from the corn's extremely cheap, just like wheat. We have a lot of timing that would support a recovery rally from this fall, this month even, into July of 2018. Just to kind of put that in perspective, if you look at from here to here, which is kind of the center of the bottoming pattern and that high, it's 36 months, and then 72 months comes out July of 2018. So we have statistically a lot of support for a recovery in corn prices, maybe not before they go down to 320 again, but a lot of upside potential, and we just don't have the participation. There's no money flow into corn yet. Soybeans, the same thing. Really not much of a rally at all this summer in the soybean market. I think James Flanagan's data would suggest that if you put corn, wheat, and beans together, it's the lowest volatility in terms of percentage of price ever in history. Which is kind of amazing considering the money flow that exists in the world. But again, we have a nice, if we can trade soybeans lower here into October, a real nice argument can be made for a recovery rally into 2018. But then a collapse into 2020 and 2022. So the theme is kind of the same, because when you go to a debt-driven, currency creation-driven model, the waves are going to kind of become the same. So in essence, the presentation is that the big picture this year is pretty much the same as the big picture last year. We still have this global inflation going on, this global currency creation going on, and it's just like deja vu all over again. And of course, when you do a big picture presentation, things don't change much from year to year. So that's kind of to be expected. But I left a little bit of time this year, as opposed to maybe past years where I run out of time, to answer some questions. And I think that one of the things that, in my mind, that is really worth noting is the position of copper and the position of a lot of these other markets versus the the position of the stock market and where we're at. I mean, this chart is extremely telling. And so when you combine the fact that land is in a position of overvaluation, shall we say, versus 350 corn, does that mean land has to come down immediately? Well, of course not. But the disconnect between land and the income that it's generating is just about as bad as it was in 1980 in terms of percentages. So it's just not a time to be buying land. It's a time to be structuring, and it's a time to be having discussions with your banker about, okay, so if land does decline $2,000, where are we at? Find out from your banker how much of his approval of your operating loan is based upon the equity in your land. It's a good time to have that discussion and know exactly where you're at, and then to take the steps to restructure to take advantage. A couple of other things that were said yesterday that were interesting to me. If corn goes back to $6, land prices will take off again. And they certainly could. I would argue that it's just more of a relief thing. It won't be long lasted, and most farmers won't take advantage of $6 corn. But when you look at that in perspective, it is we should be given a year, another 18 months in here possibly, or at least 6 months, to get things organized to handle some bad weather. And this afternoon's presentation, we'll talk about how are we going to handle that? How are we going to handle what might happen, like $4,000 land in Iowa? And of course, what are you going to see, right? I was interested in a question at the corn and soybean policy discussion. Someone brought up how we're never going to do set-asides again because it's such terrible policy. And I think farmers should lose that mindset. Why not have a set-aside? Why are we farming some of these 4% slopes? Why are we growing corn on 4% slope dirt in southern Illinois when we could be growing at least grass for cellulosic ethanol or doing something to keep the bees alive? I mean, I'm just saying, just throwing this out there as concepts. Yeah, I know set-asides don't work, and I don't like the idea of set-asides either, but I'm just saying that with the precarious position the globe is in, we need to maybe not be so convinced of some of these things, because if China gets in trouble and China can only buy 70% of the beans they bought last year, which is a very normal, healthy retracement, that's not a global deflation, beans are worth about $6. And so I think we want to keep more open minds about this. The other thing of the Farm Policy Summit down there that they had was crop insurance. I mean, the bottom line was, here's the corn and soybean growers' policy position. We're keeping all the money we got, and we're not changing anything, and we're not giving anything up, which is fine. And we got to have crop insurance, so we're not going to do that. And we don't want to means test crop insurance, so it's okay if, my friend Ben Rinchie wants to come to from Iowa to Indiana and farm 2,000 acres and take the T yield and be guaranteed not to lose any money and get, 12,000 acre farmer getting another $150,000 subsidy from the government insurance. That's okay. See, we're not going to address any of those issues that we know are doing damage to our own marketplace. We're just going to keep all that we have. And so it's an opportunity lost, but again, it's very much the man-animal instinct, right? And I think that's one of the things that we're seeing as we become more and more technically driven, and we talked about this last year. It's just fascinating to me that we now allow mind control. We accept it. When you do a Google search, who told you what you found? The engineers at Google did, and they're paid to tell you what they found. You're allowing Google to control your mind, and it's okay. 50 years ago, the people at Berkeley would have gone berserk if that happened. So it's just interesting how the technology's changed the world. It made us all a lot smarter and a lot dumber all at the same time. So, questions? Yes, Pat? Yes, I think that, so Pat's question was, the hog industry has changed so much, should we not be looking at lean hog futures but look at cutout values if we want to look at the balance of supply and demand? And I think that that's absolutely true. You know, I was talking with John a little bit earlier. You know, the hog industry, the independent producer doesn't exist, at least not in any way that's important. And so, yes, so we're going through this huge hog expansion. You know, it's not at all an accident that 2018 is 20 years after 1998. This could end extremely badly for the hog industry, probably should, actually. And when it does, what happens? Nothing happens. The three big companies that own all the hogs will just give the hogs to their bondholders, and the bondholders now hold all the hogs, and we may reduce supply 2%. I mean, it's just not going to change the throughput. It's an integrated model, and the consumer's paying for pork, and pork's going to be cheaper than beef forever, and it's competitive with chicken in a lot of cases, or at least competitive enough and tastes enough different. And bacon, of course, is, gosh, when I was in college, right, they tried to figure out how to get rid of the bacon. Now they want to re-engineer the pig so we get more bacon out of it. So, yeah, I think that's a fair point, Pat. I don't have any history on that, and I don't have a way to present that, but when we look at the hog industry and it's being so integrated, you know, I've put feelers out to people, you know, I don't want to build a quad building, I just want to steal one. They'll be available to be stolen. A lot of these guys that built quad buildings, and we've got some relatively close to us, they didn't realize it took 5 hours a day to pull dead hogs out of a 4,000 head building. They thought you were going to walk in 1 hour and push all those buttons and then go home for lunch. And most of the people that they built them for their kids to run. Very thoughtful. Is that your idea of a good program? Have your dad build you a quad barn to run, Chad? No, it wasn't what you had in mind for life, right? So it's very interesting. I think there'll be, and so again, we're going to have even more consolidation because the people most likely to buy those quads are people like Pat Duncanson in Minnesota, right? You add one. Most of the guys that have quads that know how to manage them and know how to manage their business really like the model of running them if they have a good contract with a good integrator. And I don't think that the integrators are going away. Some of them will go broke, but this whole system will just reset and keep going like it always has in the hog business and the chicken business. So, but from an independent producer's perspective, which is what we are, we just don't want to take price risk going forward, at least for the next 18 months. Let's just see what happens. And you can do that. We talked yesterday a little bit about how you can do that within the money puts. Yeah, you have to have some capital, but you don't limit the upside. You don't have $500,000 margin calls, but you can guarantee a base level of revenue. And it's really hard to do cash contracts because the basis games that the Packers play make it almost impossible. So, and kind of the same thing in the cattle business. When we talk about tactics, we talk about using in-the-money puts or selling calls to help pay for some of those things, and we'll do more of that this afternoon. But that's a really good question. Other questions? Yeah. Yeah, so the point Scott's making is this is a ratio chart, right? And if you look on here, you know, the price of commodities didn't go up from 08 to 10. They went down, but the paper went down so much faster that the ratio reset. And we're just due for the ratio to reset. That's right. And, you know, we went through last year and looked at all the S&P 500 numbers, and before the election, we had a perfect distribution top in place, and the people of America said, let's try something different. And so, in essence, we've promised even higher after-tax earnings for the corporations. So the market bid that. The market's bid the Trump tax cuts into the price of stocks already. It will be very fascinating if we ever pass a tax cut plan, if the market goes down on that. That will be kind of the ultimate indicator that the game is over, right? If the stock market would respond to some really positive news and then decline. That's what always happens in markets when you have really good news and we have a really good, strong response, and then it collapses. Right now, when we have good news in the stock market, it doesn't do much. If we have bad news, it goes down and it comes right back up every time. So, yeah, the ratio is just due to reset. and it can set on either side of the equation. I would argue it's just time for a recovery bounce in the ag commodities and in sugar and in coffee and in silver. And so if you look at what makes up that composite, it's pretty easy to see us getting a little bounce that gets this maybe more of something like this without a collapse in a global. And the trouble is, everything is so indebted. If we start a collapse, can we avoid a true meltdown? And that will be interesting to watch, to see how that works. A lot of people think they'll print money endlessly, and that works until people won't take your money. They won't take Venezuelan money anymore, even at gunpoint in Venezuela. So, I mean, at some point it can break down. But you had a question? Well, liquidate the debt usually means pay off the debt. And Rand Paul would be right on that. You'd have a fundamentally different America when you did it, because it's impossible to do. But you can print money, well, and we're doing that. We're doing that every month, because the major purchaser of Treasury securities is the Federal Reserve, which is the government and the banking sector. So I'm not the right guy to answer your question. Jason Henderson is not here. He could answer that question for you. But he's the guy at Purdue that used to work at the Fed. Jason's a real good guy. You could send him an email, he'd answer it for you. But the one thing that becomes interesting about that, it seems to me, is that because we're all momentum investing, even the central banks, and we're all going down the same route together, except the poor countries who can't. If you look at that chart of the countries and where the debts are at, if I can find it again, there it is. Australia and New Zealand are great places to go. They really are. If you could protect your capital, Mexico's a great place to go. And people down there do protect their capital. They have armies. They have their own army. So I'm not suggesting, a couple things are just amazing to me, that the strongest economic countries in the world are all still in North America. So we must be doing something right. But if you're looking about places to diversify, Australia would be a really good place to go. And when you get into the money creation, so now we've got Bitcoin, right? And we got, I don't know, there's like a new cryptocurrency every month. And I don't know what that becomes, because Bitcoin doesn't exist. It's been very a very good investment if you made it, and if you make it now, it probably might be a really bad one. I have no idea. So one of the reasons we invited Jack to come in and talk today about some futuristic stuff is the technology is coming so fast to fundamentally change things. And I mentioned yesterday, we had to go up in August. We buried Jane's mom and dad up in Lorain, Ohio. They grew up in Lorain, Ohio. Father worked in the steel mill. The biggest tube manufacturing in the world was in Lorain, Ohio in the 1950s and 60s. And he put himself through college working in the steel mill at night. And you go back there now, and it's truly a ghost town. The steel mill went to Korea and Gary, Indiana. And to see a city that has not remade itself for whatever reason. I'm not blaming the union for moving the plant. It's probably a lot more than that. It's probably more the EPA than the union that moved that plant overseas. But if you see that, you drive around our community, you see a lot of old chicken sheds. And the thing that I've become struck with as I've gotten older is not how much things stay the same, is how much they truly change. Drive 4 miles east of here. There's a $50 million complex that sells seed corn that didn't exist 35 years ago, or even 25 years ago. And so, to me, it's amazing how much things change more than how much they stay the same. And that's why we wanted Jack to come in and kind of address some of these things that we as business managers need to consider as we're going forward, and just keep in the back of our mind. And so what I'm suggesting is that the big picture would suggest that we should have a bounce in commodities. The paper assets are bizarrely overvalued. And on that bounce in commodities, we need to position ourselves for what could be the next bottoming phase, and to aggressively take advantage of that. And that means selling more than last year's corn. that's not aggressively taking advantage of it. So, and we'll talk about multi-year selling and how we use the Cargill tools to do that, and some of the things that we as business people need to think about, and one of which is managing adversity before it happens. You know, it doesn't take any kind of intelligence to see that Iowa land values are bizarrely high, and that they should back and fill, to be kind. So manage that beforehand. You know, it's funny that you think about the industry and how we've had all these, remember Mike Stamp, Rick Rosentrotter, Indiana Family Farms, gone. And those guys were supposed to be the new wave of agriculture, and they just grew too fast. You can't grow your capital base fast enough, and especially if you want to use the high rent model to do that. So a lot of things change, and I think that's the thing. We want to position ourselves to be persistent and to prosper over a long period of time, which means we may give up profits if we're a little too conservative. But we all understand that, and we're okay with that. So, a couple other questions? Anything? Yeah.
Besides agriculture, going into the future, if you've got money in stocks,
Boy, now isn't that the perfect question, right? If you have money in stocks, where do you go with it? And you're going to hate the answer, cash. But Ken, you just said the currency's going to be toast. Right, but it's not going to be toast tomorrow. And there are currencies you can go into that won't be toast. One of the reasons the Swiss franc, the Swiss bank is investing capital in stocks is because their currency is so strong, they have to keep hammering it down. Their interest rates are so negative that they're better off to take their money out of Switzerland and buy U.S. stocks even at 50 times earnings, because they're guaranteed to lose 3% at home every single year. So I don't think when they did some of the computer models for this stuff in business school at Harvard 20 years ago, they realized how human greed would force some of these things to get really out of control. And we mentioned to some friends we were visiting, and I said, boy, you just need to get all your 401k out of stocks. Well, where do you put it? Well, interest rate 0.01%, what? And it was up 20% last year. It becomes, and this is how tops are formed, right? When it looks like there's no other alternative, or if you think about the corn business, when it looks like we're going to run out of corn, that's the time to be selling corn, not right now. So, I think that's one of the reasons Bitcoin's taken off. I think really high value investors are taking money and putting it in places. The other thing to think about, though, and if Jim Dunn is here, he's an investment manager in Indianapolis. Jim will tell you, there's a lot of beat down sectors. If you look at the stock market and the extreme valuations, if you take the top 50 stocks out of the S&P 500 that are gone crazy, the bottom 50 are, frankly, pretty darn good investments. British Petroleum. And we're going to talk about maybe not using liquid fuels, but BP will do something with all that capital. There are a number of stocks, silver mining stocks. So I think the thing that's interesting is that 80-some% of the money is in mutual funds. Tons and tons of money is in like Vanguard's, just index funds. And so if you think about when's the price of corn highest, that's when you're going to run out. Well, we have all this demand for index funds. What we don't have is demand for stocks. So if you get into the stock market and do a little bit of digging, which 95% of Americans are too lazy to do, even though it's all right there on the screen, you push a button, you can pull up, look at the stocks making new 5-year lows. They're going to be the cyclical stocks. They're probably sugar producers or hog producers or something like this, right, somehow tied to commodities. And so I wouldn't want to roll my money into Iowa farmland. But why not roll my money into the underlying capacity that is really undervalued? You can look at preferred stocks. You get into some of the preferred stocks for some real stable pipeline companies paying 4% dividends. Why would you keep the money in the high-flying side of the stock market? So I think there's a lot of relatively good answers. If you just want to flip out of one index fund to another, you just need to put it in cash and just wait for. I tell people, just put it in cash for 3 years and then buy it back. How much, I mean, what are the odds you're going to have to pay more than it's worth today? Pretty low. I mean, you could. I mean, it could continue to go exponential all the way to 7 million, but I mean, we don't have the, if we had the earnings and the productivity growth underneath it to support that, but we don't have. We're bidding in tax cuts to the rich. That's what we're bidding in. And any way you want to slice it, Trump's tax cuts are tax cuts for the rich. The people like his companies. And there's nothing wrong with that. Yeah, the poor don't pay taxes, so you can't cut your taxes. Actually, most of the poor in America actually get taxes back, right? Yeah, that's actually a subsidized. You get a refund on tax you didn't even pay. So, see, so we want to become illegal immigrants then, right, Bill? Yeah. So, yeah, and so we kind of have this interesting push and shove between the poor who are the recipients of the government contracts, who quickly are becoming worth less. And then the subsidies we're trying to give them. And I don't think it's at all surprising that riots are becoming much more commonplace. The food stamps buy about 50% of what they bought 10 years ago because of the way that we, the people in control, the elite, are purposefully underreporting the inflation statistics. I mean, if you think about, even think about your people on Social Security. You know, I mean, Dad, what was Social Security increase last year, Dad? 1% or something, right? It was almost zero. Inflation wasn't zero. So I mean, we're intentionally, on purpose, hurting those people. And history shows you, if you hurt them enough, they're going to burn down your city. And it's your fault it's not there. And the other thing is, I love people, well, those people, it's their fault. They should get a job. Well, your policies did that to them, so it's hard to take ownership, but it is our fault. I haven't called my congressman once to complain about the CPI statistics hurting the poor. I haven't. I should. Just crossed my mind. But that's the outcome. And so, especially in other countries like Venezuela, when it starts to really unravel, obviously the wealthy will lose all their wealth. That's the way it works. Great questions. Yeah, Jim, one last question. Well, now that's an interesting question. You know, one of the big tax cuts is we got all this money overseas that U.S. companies are going to bring back if we just let them do it without paying tax. So where is that money right now? It's in the Swiss National Bank, it's in the Italian National Bank, it's in the French National Bank. None of those banks can allow $3 trillion to leave. They're all broke already. So you can change that law all you want, and if American companies pull out, that would be the trigger. That could be a trigger that brings the EU down. The 3 trillion or 4 trillion or 8 trillion, whatever that number is propping up most of the global debt society. So to say you're going to bring it back to America, okay, so IBM brings it back to America. What are they going to do with it? If that doesn't, they're going to send it back overseas again because of currency transactions or whatever else. I don't know if the money can actually really move or not. If you're IBM and you've got $1 trillion in Asia and you change the law, why do you bring it home? They've already got $1 trillion here, right? What's going to be in their best interest? Their best interest might be to keep it in Asia, no matter what the tax code is. It's a nice political issue, you know, that's dreamed up to talk about a lot, but I'm not sure in a marketplace that has unlimited capital already, why does it matter? So I don't buy that one as being such the big deal as everyone wants to make it out to be. And even if it comes home, why would you build plants in America with it? You've got an oversupply of almost everything. Car sales are peaking out. Car sales are dropping, which means metal. You know, we've consumered up about as far as we can consumer up, I fear. So great discussion. We're going to take a break now for a little while. We're going to come back, switch gears completely. We've kind of set the big stage. We're going to come back and talk about soil health, and it should be quite a transition, but I always enjoy hearing what they have to say. So get up, get some.